Is now a good time to invest? This is probably the most common question I get, and it's not hard to see why. The Iran war just started, the Strait of Hormuz was closed, which was then reopened, then closed, then reopened, and now is apparently closed again. Meanwhile, Moody's puts the odds of a US recession at 49%. That is 1% away from the 50% threshold that has preceded every recession in 80 years of back-tested data. The job market is down, GDP growth is down, there's potentially an AI bubble going on, and yet the S&P 500 just hit another all-time high. So to find out whether now is actually a good time to invest, I went through 100 years of S&P 500 data to show you what really drives long-term returns and what the data says about how you should invest during times like this. Let's not waste any time and let's jump right in. Now, to be fair, this is not the first time the market has felt irrational. Despite the Iran war still going on, the S&P 500 just posted its 10th biggest 11-day return over the last 15 years. Not just that, if you look at the other dates here, you'll see that most of the biggest 11-day rallies in the S&P 500 history happened in the early days of COVID in 2020 before any vaccine had been even approved. Then the best 11-day rally happened again in March 2022, again during the early days of the Russia-Ukraine war. And every single time, people ask the same question: how is the market still going up? The answer is that the market is forward-looking. It doesn't just react to today's headlines, it also prices in what corporate earnings are expected to look like in the future. So if the market thinks that the corporate earnings could go down over the short term, the market will go down. And if the market thinks that the earnings could go up, the market will go up. So simple. And speaking of earnings, we are right in the middle of earnings season. With Moomoo's earnings calendar, you can easily track every company's upcoming earnings dates. You can even set an alarm for the earnings. But it doesn't just stop there. It also shows you what analysts are expecting, how the actual result stacks up against those expectations, and their AI feature can even recap and analyze the earnings call for you. So you get the key takeaways without having to sit through the whole thing. And once you have got a company on your radar, you can dig deeper into the numbers. I'm talking about revenue growth, EPS trends, PE ratio versus its own historical range. So you can tell if a stock is cheap or expensive relative to where it normally trades. Plus, you will also get analyst price targets and consensus ratings. So you can cross-check your view against what Wall Street thinks. For those who want to trade earnings, you can use Earnings Move to analyze historical price swings and access Option Strategy Builder to see detailed P&L insights and copy trading. New users who sign up to Moomoo SG will get to earn up to $1,200 worth of welcome rewards when you fulfill the terms and conditions, which includes a $100 worth of NVIDIA shares exclusively for my channel. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading. Simply follow the steps here and key in my promo code to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. Check this out. This chart shows the S&P 500 price alongside its earnings per share from 2015 to today. From 2015 to 2019, you can see that as earnings grew, the S&P 500 climbed along with it. Then in 2020, when the pandemic hit, the EPS dropped sharply, and that caused the S&P 500 to crash along with it. But when the Fed announced unlimited quantitative easing on March 23, 2020, the market rebounded immediately, well before EPS had even recovered. And in 2022, when the Fed started aggressively hiking rates to fight inflation, that caused both the EPS and the S&P 500 to fall together. And when rate hikes were paused in 2023, both started to trend back up again, which brings us to today. The reason the S&P 500 bounced back so fast after the Iran war started is the same reason it always does. Analysts are still expecting EPS to grow in 2026, 2027, and even 2028. It might sound crazy, but even after the war started, JP Morgan is still forecasting the S&P 500 to reach 7,200 points by year end, which is actually around where we are today. Goldman Sachs sets a year-end target of 7,600 points, while Barclays is slightly higher at 7,650 points, which is like another 7% from today's prices. But why are earnings expected to keep growing? One word: AI. The four biggest tech companies, Microsoft, Google, Meta, and Amazon, are on track to spend over $600 billion on AI infrastructure in 2026 alone. And that investment is already flowing back into revenue. Microsoft Azure grew 39% year over year, with AI contributing 22 percentage points of that growth. Google Cloud hit 48% growth, and even Meta, which doesn't provide cloud services, still grew full-year revenue by 22% thanks to AI making its ads more effective while letting Meta charge more per ad. Okay, sure, earnings do look good right now, but what if things get worse? I mean, the war is still going on, the taco is still tacoing, and the oil price is still high. So what if we haven't seen the worst of it yet? As one Redditor puts it, that's the fun part. We don't know either. But that's actually a trick question, because when we are investing, we should be focusing on the long term and not day-to-day or month-to-month fluctuations like this. And the data kind of supports this. From 1927 till now, if you pick any random day to invest, you will have a 46% chance of losing your money, which is basically a coin flip. But the longer you stay invested, the more the odds stack in your favor. If you stretch your investment horizon all the way out to 20 years, the chance of losing money drops to just 3.5%. And that makes sense, because markets tend to go up over the long run, even if you pick the worst possible day to buy. Time alone is enough to almost cancel out your losses. And here's what most people don't realize. This data assumes just a single lump sum investment, but realistically, no one ever invests once and calls it a day. Instead, most people would continue investing, whether it's every week, every month, or every time they FOMO. So watch what happens when you dollar cost average into the market. If you DCA over 1 year, your probability of getting a negative return will drop by a little as compared to just picking a single day to invest. Then, if you DCA over 5 years, the odds of getting a negative return drops further. And if you DCA over 20 years, your odds of seeing a negative return will drop to practically zero. Now, some of you are going to say, okay, but that's just the US market being the US market. It's one of the best markets in the world. So of course, holding over long periods of time will give you good results ma. Okay, fine. Let's take a look at the MSCI World Index then. Again, the same patterns holds. The longer you dollar cost average, the lower the odds of seeing a negative return. This is the same for Singapore's Straits Times Index, the UK's FTSE 100, or even Hong Kong Hang Seng Index for that matter. So this is not just a US story. This is how public equity markets behave across most developed markets. Because when you invest over the short term, you are basically just betting on the headlines. But when you invest over the long term, you are betting on the ingenuity and the innovation of the human species, which so far has had a pretty good track record. But let's say you do invest and then the market drops. Did you really make a mistake by choosing the wrong time to invest? There's an interesting study titled "Even God Will Get Fired as an Active Investor." In that study, the researcher asked this question: if God is omnipotent, could he create a long-term active investment strategy that was so good that he could never get fired? In this portfolio, God will only pick the stocks that will go on to become the top performers over the next 5 years. So from 1927 to 2016, this God portfolio returned 29.4% a year, which is nearly 3 times the S&P 500's 9.9%. But even so, along the way to getting these fantastic returns, God's portfolio still saw regular drawdowns of 20% to 40%. The worst drawdown it encountered was during the 1930s, where it saw close to 80% drawdowns. And on multiple occasions, the passive index beat God's portfolio by over 50 percentage points in a single year. So if God were a fund manager, he would have been fired multiple times despite having perfect foresight. But that is exactly the point. Drawdowns don't happen because you are wrong. They are simply the cost of admission, aka the price you pay for being in the market long enough to benefit from it. Which brings us back to the original question. Is now a good time to invest? Maybe that is the wrong question to ask. Instead, perhaps the real question should be, do you have a long enough time horizon for the odds to work in your favor? If you have more than 10 years, the data would suggest that any time is a good time to invest, as long as you stay invested and keep adding consistently. That's because the volatility you see on any given day, week, or month is just noise. Instead, what actually compounds over time is company earnings. And it is earnings that drive prices higher over the long run. However, if you're only investing over a few days or months, or you're constantly worried about where the market might go next, that's not really investing. That's just speculation. And it's usually a sign that either your time horizon is too short or you don't yet have enough conviction in what you are investing in. Because after all, there's always something to be worried about when it comes to investing, whether it's the 1962 Cuban Missile Crisis, 1987 Black Monday, 2000 dot-com bubble, 2008 Great Financial Crisis, 2020 COVID, or 2026 Iran War. But despite all the worries, the markets have so far recovered from every single one. Anyway, that's all for this video. If this video helped you think more clearly about investing in uncertain times, hit the subscribe button and I will see you in the next one.